Hey, what's up, everybody? It is Wednesday, September 14th. So we managed to get a positive close, small one today. Tomorrow's the big day. It's a day that I have been talking about now for like 3 months, and that is the quarterly corporate tax payment. Already starting to see these tax drains. Yesterday we actually had about a 14 billion tax drain. There was like 8.8 billion in corporation income taxes and I think 5.9 billion in individual income taxes. So we had a 14 billion something drain yesterday. Yesterday, even with those drains, we managed to eke out a very small positive flow of 394 million. So really nothing. It was kind of like a flat day, but the spending, it offset those drains. But you know, yesterday was a huge down day in the market. Today we had a Social Security payment. I don't have the numbers on the flows today because that'll be on tomorrow's daily Treasury statement. But we may also have eked out a positive flow day. But you know, the closer we get to the 15th, people got to pay their taxes. Companies got to pay their taxes. September 15th, tomorrow they're due. And I said when it's all added up, it's going to be like 100 or 120 billion drain. And I don't think that's going to be very helpful for the market, especially now with all this, really hyped up fear about inflation and what the Fed's going to do. By the way, Fed fund futures are still pricing in a 75 basis point rate hike next week at the meeting. The probability for a 100, a full percentage point, which popped up yesterday. I was talking about that. I mean, it went from like 0% probability up to like a 32% probability. It was down today. I think it was like 26 or 28%. So it came down a little bit. The Fed typically goes with what the market expects. I mean, that's this Fed. That's Powell. In this regard, you got to keep this in mind, because in this regard, he's very easy to read. All right, there's no surprises with this guy. You know, if the market says 75 basis points, he's going to go 75 basis points. Like every single rate move, and that includes on the downside, every single rate move was dictated by market pricing, which, as I've said so many times, is crazy. I mean, why do we need a Fed? I mean, you could program that into a computer. I mean, the Fed is the monopolist. It sets the rates. I mean, looking at what the market is demanding is just ridiculous. You know, in the past, I've used the analogy of like, just imagine John D. Rockefeller, the monopolist, Standard Oil back in the day, when he dominated the oil market and oil production. If he were to ask all his little competitors, hey, what price should I set my oil? He didn't do that. He crushed those guys. He put them out of business. But Powell, I mean, look, what, am I going to get into this again? I'm not going to get into this again. These people, they really know nothing. They're in a kind of an ideology or a belief system. It's totally institutionalized. They're just going to stick with that. And they're all in a club. I mean, it's the central bankers club. It's the high-level finance people of Wall Street, other bankers, other economists. They're all in a club. They all think exactly alike. They're all wrong. They lack understanding. Their models are completely out of paradigm with what the current reality is of how things work. I mean, they're still kind of like stuck in a gold standard mentality or a fixed exchange rate system. It's useless to try to make any sense of what they do, because they just stick to the same thing. And it doesn't matter to them whether it works or not. The important thing for them is to stick with, what is accepted institutionally. That's how you stay in the club. And there's big benefits of staying in the club. I mean, that is those positions are looked upon as being very prestigious and very sought after. I mean, you want to be on the FOMC. You want to be Treasury Secretary. You want to be some big shot economist at JP Morgan or wherever, regardless of whether or not your models are correct. I mean, that's irrelevant. It's for your career. You got to be part of that group. So, don't expect it to change. But what I preach is knowledge, understanding. I mean, we use that as a tool, number one, very important. All right? It's like the laws of physics, the laws of thermodynamics. I mean, you can't go against those things indefinitely. I mean, those laws apply. Gravity, for example. Things like that. So we use that as a basis of understanding and to see where these models that they use are wrong and how they're going to backfire. But also, as I said in prior videos, and I think this is very, very important from a mental game standpoint, it keeps us protected emotionally, psychologically. That doesn't mean there's not going to be times when things are tough and gut-wrenching and you just get disgusted when you look at it. But it allows you to see the big picture. It allows you to see what's real and what's not real. And that should give you confidence. It should give you strength. It should give you protection. Okay? Very important. So, yeah, we're going to have that tax drain. If nothing happens, by the way, I still, now I'm saying 70% we're going to see weakness until October 6th, and 30% it still may end up to be what I said, in the latter part of August, where I thought a lot of that crazy selling, and also the selling that we had yesterday, which was the worst, really. I mean, that was the seventh biggest point drop in the history of the Dow Jones, because we had a 0.1%. Think about that for a second. Just take some time to think about that. It's really important. Framing, once you take yourself out of this highly emotional state, and see things calmly and coolly. I mean, that was the seventh biggest point drop in the history of the stock market, because we had a 0.1% increase in the CPI when everyone thought it was going to be minus 0.1, and we had a 0.6 of an increase in the core. Okay, that's high, but it's not the first time in history that we had a 0.6 increase. And by the way, the year-over-year trend of inflation is actually coming down. It's coming down a little bit slower, I guess, than everybody wants. And I acknowledge that. But to have the seventh, I mean, you would think we just engaged in war directly with Russia or something like something that really, really has the potential to deliver massive, massive destruction and consequences. Yesterday I talked about that investors view what is happening right now as terminal. Terminal as in the definition as in death, right? Like when you have a terminal illness. This is literally the mentality right now. It's literally the psychology that what we are seeing right now, okay? The Fed raising interest rates. And what are we talking about here? We're going to talk about a 3% interest rate by the time the meeting is done next week. It's going to be 3%. Ooh. It's terminal. Terminal, folks, meaning death. Okay? I'm using the word terminal, And you could substitute death. That is the mentality. That is the psychology. All right, 3% interest rate is terminal. So, I mean, I don't know about you, but I see stuff like that. And I mean, yesterday I was buying all the way down. As a matter of fact, I depleted. I had cash reserves, which I usually have cash reserves and I wait for market pullbacks. I mean, I just depleted my cash reserves. I have no investable cash lying around right now. I mean, it's all in. So, and I was really bummed out because, I got a list of stocks that when the market goes down, I like to place orders below the lows. And, I got like a quarter of a way down my list and that was it. I couldn't deploy any more capital. I'm going to have to add some more capital into my account. But yeah, I mean, wild horses can't hold me back from being a buyer in a day like that. I mean, you really have to sit down sometimes and just kind of like chill and get some distance and say, like, what are we doing here? What are we doing here? I mean, this is literally a psychology that the situation is terminal. It's equal to death. Like these rate hikes and this inflation trend, which happens to be, coming down. 7th largest decline in the history of the stock market. I mean, just process that. Process that for a second. So, okay, I've been talking about, that covers the, the emotional, the market psychology right now. Let me get back to some numbers. So I mentioned that yesterday was, we're now starting to see these tax drains, but tomorrow's going to be the big number. And unfortunately, I do think now that it is going to result in weakness in the market. There's going to be a lot of fear going into the Fed meeting next week. That's next Wednesday, the 21st. Between now and then, I mean, you could easily see. By the way, the PPI came out today. It was negative 0.1%. The core was a little bit higher than expected. Again, so they were making a big deal about that, how, hey, the producer prices, same pattern as CPI, a high core. And the media pumps that up, right? Just like last month, the media was pumping up. They're looking now at the year-over-year changes. They never used to do that. But now whatever is the scarier number, that's the thing they're going to focus on. And we know this. We know that, there's a pattern here. It's designed that way. It's designed to put out that scary stuff. I mean, that's what grabs attention. I mean, my stuff, if I talk about, look, stay calm, everything's cool, we'll get through this, starting from October 6th, even if we have this drain right now, everything turns positive again. Nobody's interested in that. Nobody's interested in that. People are, yawn. All right, nobody's interested in that. You want, these crazy headlines, these scary headlines. And people feel it. I don't, I'm not saying that people don't feel it, and they do. But like I've been saying, that's one side of the dynamic. Somebody asked me a question. They said, or they posted up a comment saying that they got in a discussion or an argument with a colleague because the colleague said that rising interest rates raise capital costs for companies, for businesses, and that lowers their value. And yes, rising rates do increase the cost of capital. But again, that's looking at one side of the dynamic. Rising rates also equate to larger fiscal transfers from the government into the economy. So like, I would say profit is also a very important measure of the value of a company. Maybe it's not the only thing, we could argue like growth, whatever, but profit is a very important metric for the valuation of a company. And profit equals gross sales minus cost. So if your cost goes up, right, which I acknowledge, I'm not refuting that if rates go up, costs go up. But if sales go up as a consequence of larger fiscal transfers to income, then you could definitely make a case that sales could be increasing faster than cost. And we see this, that even as rates rise, we see companies announcing like record profits. Maybe not in every sector of the economy, but we do see this transfer. We see this. So like this is a classic thing that people do. They look at half the equation. It's like these people who talk about, the growth in the money supply, right? Like the quantity theory of money, right? MV equals PT. It's like, yeah, when the government spends more, let's say it creates more money, then they automatically say that prices are going to go up. Well, there's 4 variables in that equation. Money, quantity of money times the velocity equals the price times the quantity of goods and services. One or more of those variables can change. Like if the government spends more and that induces the private sector to create more, to produce more, then if the supply rises, even as the money supply and velocity maybe goes up, if the supply rises, you don't get an increase in price, right? You could just rearrange that equation, MV equals PT, because P equals MV divided by T. You could do it yourself, plug in some numbers. But everyone just acts like all those other 3 variables are constants. And the only thing that changes is the M. It's wrong. I mean, it's just wrong. Okay? And you have to admit that it's wrong if you're going to be honest. Like, I don't know about you, but like, I got this thing about being honest. Like, I think it's important. I don't know. Maybe that's just me. Maybe I'm crazy. But I got this thing about, let's be consistent. Let's be honest. You're dealing with an equation with 4 variables, and then you're trying to make a case as if to state like all those 3 other variables are constant, and the only thing that matters is the M, the money. No, it's not. You got variables, okay? Anyway, so that's where we are. Not a lot to talk about right now other than, this quarterly. I mean, I've been telling you guys this for 3-4 months. This quarterly corporate tax payment is happening tomorrow. It's going to be 110 billion. We already have seen probably about a 30 billion drain between yesterday and Monday or Friday. Monday. And so we still got about 90 billion left to go. I do think that's going to have a negative impact, but I'm still holding out some hope that most of the selling has already been done. I mean, I've seen quarters like that before where, you get the weakness beforehand. That didn't happen in April, May, June, but we had the big one that was April 15th tax filings, and then we had barely any kind of a replenishment of those flows in May, and then we got hit again in June. So yeah, that was a rough one. But we were recovering from that until the Powell speech, and for me, that was an emotional reaction, and maybe, like I've been saying, some of that tax selling already done. We'll see. All right, everyone, take care. Bye.